Hi, I'm Steve Kamen, a resident scholar here at the American Enterprise Institute, and it's my pleasure to welcome you to this afternoon's event on prospects for the dollar and its role in the global economy. I especially want to welcome our panel of highly distinguished economic experts to this afternoon's session, and I can't think of a better group of folks to shed some light on these important issues. The order in which they'll speak is first Catherine Mann, who's the outgoing global chief economist for Citibank. Prior to her current job, Catherine was, among other positions, chief economist at the OECD, professor at Brandeis, senior fellow at the Peterson Institute for International Economics, assistant director at the Federal Reserve Board, and last and certainly least, a classmate of mine in graduate school. Stephen Roach, who will be speaking next, is a senior fellow at Yale University's Jackson School of Global Affairs and a senior lecturer at Yale School of Management. Stephen was also the chairman and chief economist for Morgan Stanley Asia, a research fellow at the Brookings Institution, and like Catherine, Joe, and myself, a former staffer at the Federal Reserve. Joe Gagnon is a senior fellow at the Peterson Institute of International Economics. He's also served as director for Industrial Nations and Global Analysis at the U.S. Treasury Department and associate director in the Federal Reserve Board. In fact, we started work at the Fed at the exact same day, let's just say many years ago. Finally, Desmond Lachman is a resident scholar and a colleague of mine at AEI. Before that, he was managing director and chief emerging markets economic strategist at Solomon Smith Barney, and he previously served as deputy director in the International Monetary Fund's Policy Development and Review Department. So by way of introduction to our afternoon session, I'll note that as we approach the onset of the COVID-19 pandemic early last year, the dollar continued to be the world's preeminent reserve and funding currency. Roughly 80% of the global foreign exchange transactions, 60% of the world's international reserves, and 50% of cross-border loans were denominated in dollars, despite the U.S. economy accounting for less than a quarter of global GDP and trade. Much ballyhooed threats to the dollar's hegemony over the previous couple of decades, first by the euro and then by the renminbi, had pretty much come to nothing. By the same token, as of last February, the value of the dollar in foreign exchange markets continued to be pretty elevated. Now, in principle, the dollar's strength might have acted to undermine U.S. competitiveness, restrain our economy, and block our efforts to achieve full employment. But as so often is the case in economics, this reverses the actual direction of causality that transpired. Starting back in 2014, a solidly recovering U.S. economy engendered expectations of rising interest rates and pushed up the dollar, even as large swaths of our trading partners, especially in the advanced economies, were still mired in sluggish growth and negative interest rates. And despite Trump's trade wars, his complaints about the dollar's strength, and aggressive actions by his administration to identify and label currency manipulators, both real and imagined, we approached the onset of the pandemic with solid economic growth and the lowest unemployment rate in many decades. Now, so far, the pandemic appears to have done nothing to upset the apple carts of the dollar's preeminence. At its outset, the dollar soared as worries about a global economic catastrophe triggered safe haven flows into U.S. treasuries. When aggressive actions by governments and central banks around the world managed to stabilize the situation, the dollar gave up those gains, but it still remains within the trading range of the past 6 years or so. And by the same token, swift action by the Federal Reserve to support dollar funding markets around the world, including the expansion of its swap lines and the creation of a new Treasury repo facility, reinforced the centrality of the dollar in the global financial system. Going forward, the swift economic recovery expected for the United States, as a result both of rapid progress in vaccinations and huge fiscal stimulus, should provide further support to dollar valuations and the dollar's special role in the global economy. But given the possible ramifications of extraordinary fiscal deficits, large current account deficits, high public debt levels, and monetary stimulus, the continued dominance of the dollar is hardly preordained. I look forward to hearing how our panelists parse these developments and I've asked them to focus their opening remarks on the following questions. First, how do you see the FX value of the dollar moving over the next couple of years? And what roles will be played by rising fiscal and current account deficits, rising government debt, rapid US growth, and rebounding inflation? Secondly, for how long can the US dollar maintain its dominance in the global financial system, given its public finances being on the current path? And how much of a threat are the euro or the renminbi? Third, until President Trump, the US administration had long espoused the view that a strong dollar was in our best interest. What sort of policy should the Biden administration be pursuing? And then finally, how might a stronger dollar affect emerging market economies, as well as global imbalances and impulses toward protection? By the way, as our conversation proceeds, audience members can submit questions to my colleague, John Kearns, either via email or his Twitter account, and he'll relay those questions to us. And so without further ado, let me give the floor over to Catherine to begin our discussion.
Well, thanks very much, Steve, for that introduction and for giving us some guidance on the way you want us to address the topic today. Of course, most of you who know me know that I love to use slides, but the various technology and compliance yielded no overlap in the Venn diagram, so we have no slides today. But let me go through some of the topics that I think are relevant when we think about answering your questions, but also starting off with that first one, which is where do we think the dollar is going to go in the medium term, and what do we think the drivers are going to be? Let me start by saying that we should no longer be using the concept of the dollar. There are many dollars. Of course, you can go all the way down to the individual bilaterals. You can go to some regionals. You can use some aggregates. But I think the point that's important to make here is that if you are a finance person, you're probably looking at DXY, which is really dominated by the euro. If you're more looking at maybe a broader set of indicators, maybe you're familiar with the Federal Reserve's real trade weighted dollar. But I think if we're trying to understand movements in various indicators of competitiveness or indicators of preeminence, then we have to start looking at much more disaggregated concepts, at least at the regional level. And that gets us down to looking at some of the reasons for why the various dollar aggregates may be moving one way or another. At this time right now, if you were to look at regional aggregates, you would see quite a bit of variation in what is happening to an Asian index, a non-China, non-RMB Asia index. You would be looking at something very different for what's happening with a commodity-based or a LATAM index or a Central and Eastern Europe index. These there's a dispersion among those indexes that are coming from significant differences in sort of the underlying drivers of various bilaterals and therefore aggregated up to the indexes. So I think, as I say, we should start our discussion with something that sort of has us stepping back from these aggregates that we all love. You know, we've always used them for a long time, but I do think that we're missing the important underpinnings of what's happening to underneath the hood of the aggregates. So that's my first point. And then, of course, we could say real versus nominal, but I think we all know about that. So let me talk now about some of the drivers of these various bilaterals and then aggregated up to the index. I'm going to focus a lot on the dollar-euro exchange rate because I think this is where some of the most clear evidence is of the drivers that we can be looking at to understand short-term, medium-term, and long-term movements in the exchange value of the dollar against its various bilaterals. Let me talk first about, a lot depends on what your perspective is. Are you a financial Are you basically betting on FX? You're going to look at different things than if you are sort of a non-financial corporate and you're trying to make investment decisions. So for which the dollar is, or the exchange value of the dollar against a certain currency is only one part of the decision that you're making. So I think we also have to address, who's the audience here when we're talking about movements. And let me tell you about a couple of ways in which this is important. For example, the very short term, mostly focused on by financial market participants, is the technicals. For example, what are the dollar shorts looking like relative to the dollar index? And again, this is using DXY as sort of the aggregate. Back in November of last year, my colleagues who business it is to do FX trading were calling for a significant depreciation of the dollar, the DXY. And I disagreed. I said, look at the technicals. The dollar shorts are really, really dominant. And yet the spot rate is not moving in that direction. So they're going to have to cover those shorts. And that's going to lead to a technical appreciation. And in fact, that is what happened. But it's not just shorts and longs that kind of drive these things. It's also things having to do with what rating agencies are doing with sovereign debt, or what the MSCI or other indexes are doing with the underlying sovereign or even corporates. For example, the RMB versus the dollar, or also versus the euro versus their own basket, really received quite a bit of an uplift, appreciation, when it was incorporated into the various MSCI World Index. By the same token, when Brazil was downgraded, there was a tremendous depreciation of the real against the dollar and also against other currencies, because there was a capital outflow that was precipitated by that basket, by that sovereign ratings change from an investment grade to a non-investment grade. So these are technical things, but if you're a financial market person, it matters a lot on following that. Now, what about some of the more standard things that economists, we like to focus on things like growth rates and PPP, purchasing power parity, or covered interest parity, interest parity conditions, and that nature. So this is where, again, it matters whether you are a non-financial corporate looking at medium term or whether you're financials. And the difference here, for example, in a growth rate is all about expectations. So financials focus on what surprises are, the deltas on surprises of data incoming, and use that as a proxy for what is going to be driving the dollar, say, versus the euro in the next, say, several months. But on a longer term basis, you would tend to look at something like, so let's think about the dollar euro. Right now, on the short term, or sort of the surprise basis, the euro, euro area is kind of doing better than expected in comparison to the U.S., which was already priced in a lot of the gains to what's going on with COVID vaccinations and opening up and so forth. And so the euro gets an appreciation boost against the dollar based on that expectation, the change in expectations. On the other hand, if you're looking at medium term, if you're going out more like a 6 to 9 months, then what you're going to be looking at is the fact that Europe is still going to be below the pre-COVID level of economic activity and growing more slowly than the US, and that would translate into a dollar appreciation versus the euro, thus unwinding some of the economic surprise support that you see in the near term. So that's, again, where financial market participants versus other participants have a different data lens that they look at, and that can yield different sort of movements, choppy waters between the short term and the medium term, sort of the 3 months to the 6 months. Let's talk about a couple of other ones where this is, again, where we think about the underpinnings of our economic theories, purchasing power parity, for example, or interest parity conditions. And again, I'm going to use the euro as a kind of an easy way to talk about this. So let's talk about something like interest parity conditions, where higher interest rates in the United States, higher than the European interest rates on investment grade securities. Normally we'd say, well, we should be having a dollar depreciation in order to offset this interest rate differentials according to, uncovered interest parity. But in fact, the way financial markets look at it is you've got investment grade securities in the US having a higher interest rate than investment grade securities in the euro area, including a hedging cost. And so that is going to attract capital inflow into the United States to invest in those investment grade securities, and that capital inflow will be dollar supportive versus the euro. So that's the way we can sort of unravel our economic principles, our theories, from an equilibrium relationship to a dynamic relationship. The same thing is true if we think about inflation differentials. Inflation differentials, the US always has an inflation rate that's higher than the euro area, or at least has for quite some time. And so normally we'd say, well, we should be experiencing a dollar depreciation based on that. But in fact, what matters is not the differential, because in an equilibrium sense it might matter. It might yield that depreciation, but in the interim period, since we're never really in equilibrium, it's the narrowing of the inflation differential against the US that is going to contribute to an appreciation of the dollar in the near term, at least against the euro area. We can also look at central bank balance sheets, and that can give us guidance for prospects for policy rates and tapering, and then policy rate changes. And again, we have very much dollar supportive evidence coming from probable balance sheet behavior. So let me turn now to sort of the longer term, longer term drivers, which were part of the introduction that Stephen gave, having to do with things like the current account deficit, net international investment position, the fiscal deficit, debt to GDP, all those long-term things that I know maybe Joe's going to mention, but of course Joe has research that shows that in the long term, these things should matter, that the persistent U.S. current account deficit, negative net international investment position, rising fiscal deficit, debt to GDP rising, all of these things should be, in the long term, dollar negative. In other words, a depreciation of the dollar on a general basis against a variety of currencies. Yeah, well, maybe, but we don't get to the long term. We have an awful lot of short terms before we get there. That's number one. And number two, we also have to kind of recognize that there are some consequences, that the current account deficit is an outcome of faster growth. And so whether the dollar gets to appreciate because of the faster growth dynamic versus depreciate because of the current account deficit dynamic, how that plays out in the short term and then the very long term, years out, is something, again, we hardly ever get to the years out, not the dollar. Of course, emerging markets is a different matter because they have a much smaller role in the global economy, and they are much more driven by their external position, their coverage ratios for trade, for example, or the characteristics of their debt liabilities, whether they be dollar denominated or local currency denominated. On the debt burden and a number of other these, in the medium term, yes, U.S. debt burden is rising, but so is everybody else's. So, in the end, the dollar is a summary statistic of the set of those factors, and so it's not clear. You cannot just look at the U.S. On either the current account, net international investment position, debt to GDP ratios to conclude. The last point that I want to make is about productivity growth. And I think that this is a potential place where a lot of the negatives that we might see in the long term, coming from external balances and internal balances and debt buildups, both internal and external, the productivity differential is a really important ingredient. We often think that emerging markets should have appreciating currencies because they have the potential to grow more quickly. They have the demographics that give them faster growth in aggregate supply or potential output. But if we look at the post-GFC productivity, the productivity outcomes, the emerging markets have had the deepest slowdown, the greatest slowdown in their productivity, is even compared to the advanced economies. And so the hole in terms of productivity growth that the emerging markets have to dig out of before any of that kind of productivity potential output dynamic might start to be reflected in their currencies appreciating relative to the US dollar, they have a huge hole to dig out before they can even start to have that dynamic make any sense. And so this question about the relationship between currencies and productivity, very long-term relationship, is one that I think deserves more attention as we think about the sort of the long-term trends that we might observe, not only in the dollar, but in sort of all the other currencies in the buffet table that we might have out there to look at. Thanks very much.
Catherine, thank you very much for that both comprehensive and really analytically rich discussion. A lot of food for thought there. We have a few minutes to chat in between presentations. And I wanted to kind of follow up on your discussion of the euro, which I believe has moved more or less in the same way as the Fed's overall advanced economy dollar index. Kind of like, declining through a lot of last year, but then picking up through March or April of this year and then falling back. And I guess I would have thought that with the, as it became apparent that the U.S. was going to get vaccinated a lot sooner than most other economies, and even faster than in Europe, and as it became apparent that inflation was probably building up more rapidly in the United States than other economies, but both of those factors, by pushing up U.S. interest rates, would have really pushed up the dollar a lot over the course of this year, with some presumption that it might even go higher, throughout the rest of the year. But that actually doesn't seem to have happened. In fact, the dollar has fallen against the euro and against other advanced economies over the last, month and a half or so. While we economists don't like to focus too much on short-term developments, this seems to undermine kind of like a narrative of stronger U.S. economy leading to stronger dollar. So I'd love to hear your comments on that, and maybe if other people have things to say, they could say them too.
I think it's two things. One is, are you looking, again, the financial markets look at not just data coming in, is it greater or less than expectations? They are also looking at probable central bank actions. So, as I said, data, the U.S. vaccination, the success at the vaccinations, the success of opening up, the fiscal budget stimulus underpinning U.S. growth, in some sense, all of that was priced in. All of that was priced in a while ago. So that meant at the margin, the new information coming in that was affecting the exchange value of the dollar versus the euro was the data surprises coming out of the euro area. So Europe ended up being better off than most people thought, and so that at the margin tends to yield a euro appreciation. The inflation story is a little bit more nuanced because, as I said, yes, the U.S. Inflation is rising, but so too is the euro areas. And their surprises on inflation could easily be larger, or at least, especially driven by energy prices, could easily be larger than we see in the U.S. And so, as I say, it's not inflation differentials that drive the dollar euro. It's the narrowing or the narrowing of inflation differentials. So it's the dynamic of whose inflation rises more or is expected to rise more, and that would tend to be dollar positive and euro negative. So I think the jury is still a little out on where the dollar may settle in sort of the summertime, and I would agree with you that it's a little, your time horizon for prospects for the dollar versus the euro, you know, in the next 3 months versus the next 6 months, I think we can go, it's important to go to the question of the question I think is most important for the 6-month horizon, maybe the 10-month horizon, is will the fiscal plans that are currently being evaluated in the United States, the jobs plan and the family plan, which have infrastructure element to them, how will that promote faster potential growth in the U.S. relative to prospects in Europe for the next gen EU to similarly drive potential output in Europe? To me, those are the important questions to be thinking about for where the dollar euro is going to be 10 months from now.
That makes sense. Do any of our panelists, Desmond, have a comment?
Yeah, thank you very much, Catherine, for those comments. But it seems to me that you're not mentioning two big elephants in the room as far as the euro-dollar exchange rate is concerned. You know, the first elephant, I'd say, is the damage that COVID have done to the finances of Southern Europe. You know, so what we've seen again is debt problems in Southern Europe that are extremely bothersome, you know, big budget deficits and so on. So we could very well be heading towards another round of the euro sovereign debt crisis, or alternatively, the European Central Bank is going to have to print a lot of money to keep countries like Italy, Portugal, Spain afloat. You know, that's the first big elephant that wasn't mentioned. The second big elephant is it looks like with the mix of policies you've got in the United States, it's only a matter of time before Federal Reserve has to raise interest rates, bubbles begin to burst, and then we've got the whole safe haven argument, you know, in favor of the dollar. So, you know, I can buy, you know, short-term technicals, but if you're looking within a year's period, I don't think that one can exclude, you know, either another round of the euro sovereign debt crisis or the bursting of the global everything bubble, you know, both of which would be highly dollar supportive.
I'll agree with you on both of those. Although if I was hewing strictly to the external balance theory of exchange rates, then that would be supportive of the euro and not of the dollar. But I agree with you that I think that if there were a sovereign debt crisis in Europe, then we could be looking at much higher interest rates there, and that could turn the tables in a different way. But it's certainly no exit issue, I'm sure. But the safe haven argument, I'll agree with you there, because it's true. The last time the turbulence in the financial markets was promulgated by the United States, we still got to be the winners when it came to being the exchange value of the dollar.
Well, talking about the external balance and its effects on the dollar, why don't we now turn to Dr. Stephen Roach? Hear what he has to say.
All right. Thank you very much, Steve and Desmond, for pulling us together. And I'm not nearly as eloquent as Kathy, so I'm going to resort to the to some slides to try to convey some of the things that I would like to discuss in my 10 minutes. I'm going to just set my little timer so I make sure that I'm on schedule. Can we just go to the first slide, please? Or the next? There you go. You know, to Kathy's point, you know, everybody's got their favorite index. There is no single index. I'm a big fan of the indexes that are put together by the BIS. So this is a long history of the real effective exchange rate of the U.S. dollar back to 1969. And I've shaded in 3 areas where there were indeed sharp corrections. The 70s, a short period in the mid 80s, the first decade of the 2000s. And I've put a little shade for right now with a question mark because I recognize that that's the subject of this discussion and there will be competing views. But if you look at those three earlier periods, these are sharp declines in the broad. Actually, this is the narrow measure of the real effect exchange rate, but it's still a very broad index. I would prefer to take the broad one back, but they only calculate it through the, I believe, back to the late 1980s or early 1990s. But just go to the next slide, if you would. I've chosen to focus a lot of my comments today on the dollar's relationship to two characteristics of the balance or lack thereof in the United States, largely the current account balance, which is chronically in deficit, juxtaposed against our domestic savings rate. Shown here is the net national savings rate, which is the combined saving of businesses, households, and the government sector, all adjusted for depreciation. I believe this is the best way to look at aggregate savings for many reasons, but the most important being that this is the savings that we have left over to fund domestic investment or the growth in our net domestic investment or the growth in our capital stock. And when we don't have enough and we want to grow, we borrow from abroad and run current account deficits to attract the capital. And our domestic savings rate has been declining on a long-term basis for quite some time, and not by coincidence. The current account has been in deficit to reflect that a shortfall in U.S. Saving. The relationship between saving the current account at the bottom of the slide and the dollar is, it's not perfect, but over the long sweep of time, consistent with Kathy's point that maybe this is a long-term way to view the ups and downs of the dollar, periods of weak domestic saving and widening current account deficits are do coincide with periods of weak dollar. I'm getting a little feedback here. Is somebody, one of our technical people?
Yeah, I'm hearing a little echo, Stephen, but I don't know that anything's changed. Maybe one. You can still be heard, so I would continue.
All right, I'll just continue to speak and listen to myself.
Sounds okay right now.
Playback. Okay. Let's go to the next slide, please. So what we've done here is for each of the three prior periods of dollar weakness shown on this BIS basis, I've shown you the average net domestic savings rate in the middle column and the current account balance on the far right column. And the two shaded areas pretty much underscore my point, and that is that the dollar in these three earlier periods was down on average 31% real effective exchange rate. The net domestic savings rate averaged 4.9% during those three earlier periods of dollar weakness, and the current account deficit averaged negative 2.5% of GDP. And then the bottom row is where we are today. And we're very deficient on a domestic savings basis. Our current account deficit is worse, but not by a dramatic fashion. And my view is that we ain't seen nothing yet. That the net domestic savings rate is going to go sharply into negative territory thanks to COVID-related runaway budget deficits. I take Kathy's point, it matters compared to what, compared to who, but we are going on this great fiscal adventure at an exceptionally low domestic savings rate, and in contrast to, say, Europe and China, just to pick a couple of random alternatives, they're running current account surpluses, and we're not. And with our domestic savings rate likely to go sharply into negative territory, I would expect the current account deficit to widen in a dramatic fashion, quite possibly breaking the previous record of about 6.5% of GDP hit, I want to say, somewhere around 2006, 2007. So just go to the final page, please. If I want to sort of summarize the negative view of the dollar, and I'm not going to be dumb enough to tell you when. I mean, I'm an old sort of recovering forecaster, and I learned early on that you can give a forecast or a date, but never both. So I think the dollar is going to go down sharply, reflecting four considerations that are listed on the left-hand side of this slide. The saving and current account deterioration is going to be a lot worse, starting from a much more severely impaired position than other major economies in the world. Normally, when there's a current account problem in any country, it is met by either central bank tightening or a currency correction. Our Fed is never going to tighten again for the rest of our lives. They're into average inflation targeting. They won't tell us what that means. They won't tell us over what time period it is. But we all know that the U.S. has undershot the 2% target for a long time. So, they're digging in their heels on this point, even though we're seeing a lot of whiffs of inflation right now. So that puts the current account adjustment, the onus of the current account adjustment, more squarely on the dollar. Thirdly, this is this great view that the dollar is the world's dominant reserve currency and will stay that way forever. Certainly, the dollar still remains the dominant reserve currency, but its position is slowly eroding. The IMF put out, I guess, the 2020 numbers quite recently, down to about 59% of official foreign exchange reserves, a 25-year low. The euro is, I'll get to that in a second. Certainly the number two reserve currency, and there's a lot of questions as to whether or not the euro can fill the void. There are even some questions about the renminbi. And then there's the alternative that I put on this page that, I should have learned a long time ago, never submit anything until, 30 seconds before you're going to speak, because the cryptocurrencies were beginning to get some whispers about a possible alternative to the dollar. And now, of course, they are imploding as we speak. So we can probably strike that from the page. And then the final point is just valuation. On this BIS basis, the dollar is probably the most overvalued major currency in the world. Through April, 24% above the July 2011 low. And the euro, maybe for good reasons, is, I think, the most undervalued major currency in the world. It's down on the same basis about 13% below its high after the GFC. And just a brief note on the euro. I've been a euro skeptic basically all of my sort of professional life. I really thought that the currency union would have been gone long before now, but it hasn't. And the main reason I've been a skeptic is that while there's a single central bank and a single currency, there's never been a pan-regional fiscal arm to the policy arsenal. And I think that's the potential of the next generation EU fund with that's coming alive with sovereign bond issuance authority. And, we'll see if that makes a difference for the undervalued euro. Bottom line for me, though, is that we've had three major corrections of the dollar since the demise of Bretton Woods. I think there's a compelling case to be made for a fourth one, whether we're in that early stages of that now or not. I think it's coming. And for a saving short, current account prone U.S. economy, I think the dollar is likely to be weaker rather than stronger over the next few years. It's certainly premature to say this is the end of the dollar's dominance as the world reserve currency, but that who knows if that will ever happen. Certainly not in my lifetime. Kathy's point is a good one. We never get to the longer term, but I don't know about the rest of you guys. I sort of feel like my lifestyle is taking me there pretty quickly. So, I'm living the long term right now, and I think the dollar will, probably be weak before this long term becomes shorter and shorter. So I'll stop on that.
Stephen, thank you very much for that very thorough and provocative analysis. I want to just kind of follow up on a couple of related issues. One of them is I was looking at those charts, the same ones that you kind of showed, and it looks like the U.S. current account balance was more or less in balance around zero, like in 1990. And it kind of like deteriorated for 12 years through 2002 before, the dollar finally peaked and started depreciating. So I understand the rationale for why a current account deficit should lead to concerns about dollar valuation that bring down the valuation. But it seems to take an awful long time. But I gather that you have something shorter term in mind for the dollar this time. So that's kind of like wanted to ask you to kind of like flesh out like the timing issue. And then as a related matter, just looking at your charts, it looks like the dollar might actually be a little bit better correlated with declines in the saving rates, even than with declines in the current account balance. And I actually don't understand like the economic rationale for that. You know, why would it be that more spending, leads, by American entities leads the dollar to decline when it should push up interest rates and support the dollar? So, I'd love to hear your views on that as well.
Yeah, those are two great questions. I would probably not agree with you that, up until 1990, the current account was in balance. There was 1 year.
Yeah, I just meant in 1990.
Yeah, I mean, it just so happened that, we charged the world to fight the Gulf War. And so we got a lot of capital that pushed the current account in balance for one brief period. And the current account has basically been in deficit consistently since the early 1980s. That was the only year that was an exception. And, I think the thing that's just got my attention on this is that I think, you're right about the correlation with the savings rate, which is something of a puzzle, a tighter correlation, as you pointed out. But I think that something very big is about to happen, and very immediate and compressed in a short period of time, to domestic saving, that is going to destabilize the current account deficit in a way that we haven't seen in a long time. And that is these, multi-trillion-dollar budget deficits that, the current administration is pushing for very aggressively, and it's a contentious political issue. We all know that, and the near-term consequences was, as long as the Fed, plays ball and does what I said earlier, they never raise interest rates. It doesn't cost anything to run big deficits, but that is not something that persists forever. There will come a day when, maybe this day gets forced to be sooner rather than later because of what's going on in this so-called inflation scare. It's hard to say, but the Fed doesn't seem in the least bit inclined to play along with market chatter on rising inflation. But there will come a day eventually when they begin to normalize, and then this fiscal adventure will hardly be one without consequences. And so I guess that's my basic sense of the dollar. I think about what's going on in the world right now, and in the aftermath of this unprecedented shock that we just went through. And I think about some of the unusual things that are going on with respect to policy, and how the United States, relative to other countries, really entered this unusual period with an already sharply depressed domestic savings rate and a current account deficit, which is different than other countries. And so we will experience more deterioration from a weaker position than others. And I think there will be consequences for that. Given the Fed's intransigence, and given what I still think is a relatively sticky outlook for inflation, I think the thing that is likely to give the most will be the dollar.
All right. Desmond, did you want to interject quickly because we want to move on?
Sure. I just wonder whether Steve is giving too much weight to current account developments in moving exchange rates rather than capital account developments What I've got in mind is that if you've got a big change in the mix of policy in the United States in terms of a massive budget deficit, that's going to imply you're going to have high interest rates in the United States that'll draw in the capital, and the balance of payments has to balance, so the current account deficit will widen. So, I wouldn't see it, certainly in the next year or two, I would have thought that you're going to get strong capital movements into the United States that are attracted by the high interest rates in the United States than in the rest of the world. I'd just be curious what your view is, whether capital account developments can change the view or forestall this day of reckoning for quite a while.
Well, I think they can, Desmond, but I think the Fed has to play ball to get interest rates up, and I don't think they're going to do it.
Well, even if they taper, it's not just interest rates. It's not just policy rates that matter. It's the pace of tapering that also is very relevant in thinking about the underlying position of the central bank, particularly the Federal Reserve, vis-a-vis the euro area, which is much further down the line in doing anything with their central bank asset purchase.
Well, fair point, but I'm a little suspicious of a Fed that, sort of sits there in the master control room with their multiplicity of new tools and just sort of calibrates everything, whether it's, asset purchases or forward guidance or, more definitive calibration of what the average inflation target is that they're trying to hit, and they can just keep everything in perfect order. I think it's a slippery slope.
All right. Well, I think we have a very rich set of arguments to have after our presentations are over. But Joe needs to talk about what the U.S. government can do about the dollar. And then Desmond needs to explain that it's all really moot because the financial system is going to explode. So with that, let's hear from Joe.
Oh, okay. Thanks, Steve. I guess you can go ahead and put up, I have some slides. So I'm here to talk about what the Biden administration, or really any administration, I said the same thing to the Trump administration, should do about dollar policy. And it won't surprise some people that over the decades, I think the benefits of being a reserve currency have diminished, and I think the costs of being a reserve currency have increased. And so I'm sort of less enamored of that. But next slide, please. The brief summary of my remarks, just in case you get zoned out because I talk too long, I hope not, is that the U.S. net debt to the rest of the world, which is basically the accumulation of our ongoing trade deficits, as people pointed out, have been going on since the 80s, has grown from 0 to 70% of our economy. This is the biggest transfer of borrowing of any country in human history by a long shot, and this is not on a sustainable path, as you'll see. There are two big factors behind it. I'll talk about one, of course, is fiscal policy, as we've been talking about, and I'll come back to that too. But an even bigger factor in my regressions, my statistical analysis, is what governments do to manipulate exchange rates to accumulate foreign exchange reserves and sovereign wealth assets. That seems to be a very big cause of these trade imbalances, especially for the U.S. The U.S. is the major country whose assets are being bought, and that's why the dollar has been overvalued for so long. And I'm particularly worried now because when we have very low interest rates, this becomes a beggar thy neighbor policy to get growth at your neighbor's expense, and I think it's potentially harmful. I think the U.S. has the tools to take action, and I recommend that we do. And I think, in principle, it should be fully consistent with what the IMF and the G20 have been saying for a long time. We want to narrow these stabilizing and excessively large trade imbalances, and I'd like to see a coordinated effort. Next slide, please. So this is just the facts. What you see here is the gray line is the trade deficit measured by the current account. It was in balance or surplus in the 50s, 60s, 70s. Then in the 80s, it took a turn downward, and as people said, only 1 year of the past 40 have we been in balance. And the result has been accumulation of net debt to the rest of the world. The solid black line is our net international investment position, and a negative number there is a net debtor position to the rest of the world. That reached 70% of our GDP last year. Just an incredible number. And I remember Steve and Kathy and I worked together on this decades ago at the Federal Reserve Board, and I never would have believed we would have got to this point. I mean, I'm just astonished that this has happened, but it has. And if we don't fix our trade deficit in the long run, this is just going to continue. But I don't see how it can continue. No country has sustainably managed, no major country has sustainably managed such a large debt going forward in the past. So next slide, please. So why am I worried? Well, as I said, I think I'm particularly worried in an era of secular stagnation, sort of with people near the zero bound and with large fiscal debts in many countries that they're reluctant to use fiscal policy and they can't use monetary policy and they're looking for a way to grow. And they seek growth through depreciating their currency and expanding their net export. And I think this is a worry. I looked recently in doing some research on central bank statements from major central banks around the world, and it's just amazing how they're quietly pleased when their currencies depreciate, and they're noisily unhappy when their currencies appreciate. And I can find many quotes of them being noisily unhappy whenever there's upward pressure on their currency. And so this is just, I think we're all sensitive to this. What my research shows is that a massive increase in what governments do in terms of buying foreign currencies is the single biggest factor behind the persistent trade imbalances and the growing net indebtedness of the US. Fiscal policy is number two, but it's actually not a particularly close number two, but it is number two. I fear that, so I hope Steve Roach is right in his remarks that events will conspire to move the dollar down. I fear that if they do, countries won't allow it. Basically, what we see is countries step up their intervention in foreign exchange whenever the dollar is weak, because they don't like a weak dollar, they want a strong dollar, and they will not allow the dollar to be weak. We see that a lot in the past 20 years. But I actually think that another possibility is that the Fed is going to have to raise rates because we're going to get more inflation than even they want. That's my baseline forecast. Next slide, please. So just to show you, I want 2 slides just on the evidence. Why do I make the strong assertion that what governments do to intervene in the foreign exchange market is so important? And this is a government distortion of markets, and that's why I think we should worry about it. Well, this slide shows for advanced economies, a similar slide holds for developing economies. It shows that on the horizontal axis, we have their foreign exchange reserves and sovereign wealth assets as a share of GDP. And on the vertical axis, we have their net international investment positions. And what you see is the regression line with just one variable has a R squared of 0.6, astonishing R squared for one variable. And the slope coefficient is 1. So every dollar that countries buy in assets basically supports their trade balance over time by $1. I was astonished when I saw this. I don't think anyone would have expected it. Next slide, please. So this just shows the same thing in regression analysis over many more countries. So what I have here is a regression of the net international investment position on 3 variables: the net official holdings of foreign assets, the gross government debt, and their wealth, PPP, GDP per capita. Wealthy countries tend to have a positive net foreign assets. And what you see is by far the most important variable in terms of explanatory power, in terms of robustness, is what countries do within the currency markets. That has a coefficient of 1 for advanced economies, for developing economies with reverse regression. Back in 2010, it was true. It's also true if you just accumulate current accounts instead of looking at the net asset position. I mean, that takes out the valuation effects. It's still true. Government debt, fiscal policy, in other words, is important, and it has the negative effect. As governments borrow more, they raise their debt. That reduces their trade balances. And it's usually significant, but not nearly as robustly and not as strongly. And in terms of explanatory power, it's less. But it is number 2. And the R squareds here are quite high for such a small regression. Okay, so next slide, please. So I don't want to spend much time on this, but there has been talk about currency manipulation, and some of you may know I wrote a book with Fred Burston a few years ago on this, and we put up our proposed definition. Treasury has used some of our ideas and not others. Basically, in my view, if a country has more reserves than it could ever need, and it's buying even more, and it has a large trade surplus, that's a currency manipulator. It's basically propping up a large trade surplus for mercantilist reasons. Next slide, please. So using the criterion I developed with Fred, I looked at all countries in 2020, what they did with their intervention and sovereign wealth purchases, and also what their current accounts are doing. And what I found is 7 countries here that exceeded the criteria Fred and I set up, starting with Singapore and Switzerland. As you can see, the sum of these countries is shown in the bottom row. Their interventions in foreign exchange markets more than doubled last year, from 190 billion to 443 billion dollars. That's a big number, although it's not as big as it used to be 10 years ago when China was in the game. China was the biggest by far, but China hasn't been doing so much of it lately. And the interesting thing is these countries that are manipulating their currencies have a combined current account surplus, trade surplus of 318 billion last year. That is bigger than any country, any single country. It's bigger than China, bigger than Germany. Just a few medium-sized countries do matter. It's not, it can't be ignored. It seems to me the Biden administration should look into this, should do something. Next slide, please. So what should the Biden administration do? Well, Fred and I have argued that we should do countervailing currency intervention. If a country buys our dollars to hold the dollar up and give us a trade deficit, we should do exactly an equal amount in the opposite direction that would fully neutralize any effect on exchange rates and trade. I think that would be justifiable under Article 4, certainly, or any reasonable standard. But unfortunately, it would need congressional action because we can't do it now. The Exchange Stabilization Fund is just way too small to be credible. I think you'd either need to exclude the Exchange Stabilization Fund from the debt ceiling. In other words, we'd need the ESF to be able to borrow in dollars to buy foreign currency, and that would have to get around the debt ceiling. Maybe it could be done on a net basis instead of a gross basis, I don't know. Or the Federal Reserve could be tasked with this policy. The Federal Reserve is not subject to the debt ceiling. Of course, this would complicate the Fed's mandate, but it would also give the Fed a new instrument to use, and they could reserve this instrument for that part of the mandate, that is trying to stabilize the current account balance, and then use their traditional tools for the rest of their mandate. So it makes life more difficult for people that have Steve's old job now, but it doesn't make it impossible. And the final slide, please, is what excessive intervention, currency manipulation, so defined, is important, but it's not the entire problem. Even normal reserve accumulation or potentially normal reserve accumulation builds up and keeps the dollar too strong and gives us a trade deficit. Also, private sector to some extent is also encouraged to buy dollars more than perhaps is ideal. I think we would want to go a bit beyond. This goes beyond what Fred and I said, but I think we'd want to sort of have a policy of countries intervening in a stabilizing direction rather than a destabilizing direction. The U.S. could do this, other countries could do it. Deficit countries could intervene to reduce their deficits. Surplus countries could intervene to reduce their surpluses. If that's if that's not considered enough, we could consider capital flow measures. The IMF has done some work on when you could use capital flow measures or inflow taxes to fight an excessively large deficit. And it's interesting that the criterion they have put forward seem to apply very well to the United States. It seems to me, even if the United States wasn't in mind when they drew them up. I think one thing I have to come back to is fiscal policy. Obviously, U.S. fiscal policy is just enormous right now, enormous deficits right now, way out of whack with the rest of the world. I don't think it's a bad thing per se, but that obviously I believe will make the trade deficit bigger. And I don't think we should aim to offset that. The goal should not be to completely have balanced trade, but to have balanced trade. The excessive part of the trade deficit should be offset to some extent. And then I think that IMF should step up and really do its Article 4 duty a lot more aggressively than it has been. It should be the traffic cop here. It should be signaling when countries should intervene or take capital flow measures and when they shouldn't, based on stabilizing these very harmful imbalances. Thank you.
Thank you, Joe. That was very interesting, provocative, and I encourage you to send many emails and phone calls to our former colleagues at the Fed, harassing them on this point. Or perhaps you already have. So I wanted to just ask you a couple of questions, just follow up. First, and this is a picky little thing that we ex-Fed people like to do. When you showed the graph of net debt for the United States, deteriorating to 70%, was that the net international investment position? And does the giant plunge recently actually reflect higher stock prices owned by foreigners? And if so, wouldn't that be not necessarily a worrisome thing? That's my first question, but go ahead and answer that.
It does. So I think I would expect some bounce back. I mean, I was taken back by how much it plunged, but I actually think we'll get some bounce back as foreign stock prices catch up. And if the dollar depreciates, that would also help. So the history, if you look, the connection between the trade deficit and the NIIT isn't there's an valuation effects are important. So yes, but the trend is there. The trend is there, and the key thing is that if you correctly measure the net investment income being paid out to foreigners, taking out the tax haven effects, it is negative, about 1% of GDP.
All right, which is not nothing. And then I had a broader question. The first one was more of a picky Washington gotcha question. But the broader one is, so as many folks are pointing out, including I think Larry Summers in the Financial Times today, U.S., we're going to run a monster fiscal stimulus, and we got all this pent-up demand, and it's going to push up lots of prices, and it's going to be bad. And wouldn't that be a great time for the rest of the world to have a sale on their goods and to sell us as much as they could as cheaply as possible, by helping to push up the dollar? So wouldn't this be a good time for maybe the Yellen Treasury to sort of mellow out a bit on your initiative, and then maybe a few years from now you could pick it up?
Fair point. I think this massive fiscal policy, which really no one saw coming until about January, basically, is really changing all these calculations. And I think the underlying forces will come back at some point, but temporarily. You may be right. I do worry. I mean, and I think it's great if emerging markets, and especially in our own hemisphere, can get some growth from exporting to the U.S. I would welcome that, and it would dampen inflationary pressures. But I do worry that over time, how sustainable is it politically that we have massively mortgaged our children's future to support jobs in Germany and China? Because a lot of these jobs are not going to be in Brazil and Mexico. They're going to be in Germany and China, where I don't think the political support will be there.
That's an interesting point. Would anybody else like to? Catherine?
So, you focused a lot on countries who do not want to have an appreciation of their currencies, and they make every effort to prevent that from happening. So I think we need to go to ask why it is that they are acting this way. What is the policy that, for at least in their view, that this is a policy that is supportive of their own economy? Because otherwise, you have a problem with this policy initiative at the U.S. side, the currency manipulator side, and try to do, each side does their offsetting of currency manipulation. So, if we go to the crux of the matter, the question is, why is there so much fear of an appreciation? And so I think what are the consequences? So I think one of the things that has not been addressed sufficiently in the context of this currency manipulation genre is if we look at emerging markets and we look at the size of their international reserves, dramatic, huge, and how they are deployed, which is it's an insurance policy, it's to prevent currency movements. We can also correlate that with this dramatic deterioration in prospects for growth in emerging markets, a deterioration in their productivity, a deterioration in their domestic demand, a deterioration in their rate of growth of potential output. So when we think about what's happening to this international reserves portfolio that emerging markets have kept on the sidelines to kind of, as their insurance policy against turbulence in asset markets and the exchange rate consequences, I think an important thing that we could do as researchers is to say, look at what has the consequence. I know you think that a currency, volatility and so forth is bad for your country, but look at the consequences for your country of holding on to this essentially massively wasteful international reserves portfolio. You haven't been able to spend it on your domestic infrastructure or your innovation or your people or whatever. But again, pairing up international reserves dominance, productivity deterioration, and I think that might change the terms of the debate a little bit.
Fair enough. If I just say, I think Danny Roderick has worked in this area a bit too, that it's a bit of a paradox why you would think countries that really could use that capital productively more than us are spending so much money. The fiscal drag of reserve holding for many countries is significant. In China, 10 years ago, it was more than several percent GDP. I mean, it was, and it's shrinking as China's economy is growing, but it's amazing that these countries are paying a big fiscal cost to hang on to dollars. But it seems to be that the strategy of growing through trade surpluses for them has been more sustainable than other strategies they tried, and that's the big thing. Is how can we help them? I think a global infrastructure push might be a good. I think the G20 was right to do that, and of course now we look at Belt and Road and maybe we don't like it, but.
So I have another answer to the mystery of excess reserves, which is that finance ministers don't get fired for below par productivity performance. They get fired for financial crises. And the more reserves you got, the safer you are. And so with that, that actually leads into our last but not least speaker, Desmond Lachman, who will talk a little bit about that and other things.
Thank you, Steve. If I could ask John just to put up the slides. Okay, if we go to the first slide, basically, I'm very much in the camp of being dollar supportive for the next year or two. Even though I can see, I buy Steve Roach's idea that in the long run, we'll have a dollar crisis, a day of reckoning for the dollar, but I don't see that anytime soon. And I'd say that for three reasons. First is that I think that the US economy is going to be overheating pretty soon. We're going to get bubbles bursting. That's going to be very dollar supportive. The second is the emerging market situation is totally unsustainable. If we get rising interest rates in the United States, we're going to get real currency crises in the emerging markets. And the last, I'd say, is Italy. I'm just singling out Italy, but I could be speaking about Spain or Portugal, is really going to cast a very dark cloud over the euro for a long period of time. So if we go to the next slide, let me just substantiate these points. We could even go to the next slide. The argument that the US economy is going to overheat, I don't find that very difficult. I just put up this chart showing the size of the fiscal stimulus that we're getting in 2020, 2021 dwarfs what we got in 2009, 2010. So, if you look at 2021, at a time that the CBO is estimating that the gap is 3%. We're throwing something like 12% of GDP at a 3% problem. That, if we go to the next slide, that enormous amount of budget stimulus is occurring at the same time that the Fed has got its pedal to the metal. That if you look at the broad money supply, we haven't seen money supply growth like this the last 40 years. We're looking at the red line, the United States money supply growth now, broad money is growing at 25%. The least that's telling you is that there's a huge amount of pent-up demand in this economy that's going to be released. So we've got large budget stimulus, large pent-up demand, and we've only got a 3% gap. I just don't see how that doesn't lead to an inflationary problem. I'm not even talking about the supply side problems that we've got, chip shortages or unemployment insurance that are stopping workers from going into the workforce. So you've got a supply problem as well. We get inflation. Once we get inflation, I don't buy the idea, if you get 4, 5, 6% inflation, the Fed's going to move interest rates. And even if the Fed doesn't move interest rates, markets will move interest rates, as the next slide shows. This shows that the long rate, if you look at the 10-year Treasury long rate, we've seen increase in 10-year Treasuries at as fast a rate as we got during the taper tantrum in 2013. And I'd say that if the Fed is behind the curve, what we're going to see is these 10-year bonds blow out even further. Markets will dump those Treasuries to long-term rates, and that'll burst the asset price bubbles. I've just chosen two. I could have chosen Bitcoin. We've just seen Bitcoin halving in price the last week or two, just wiping out $500 billion of wealth, but that's a minor point. The bigger point is in the next slide, which shows US, if you look at the Shiller P ratio, the CAPE, we're at 37. It's double what the normal average is. That is entirely, in my view, that is premised on the idea that interest rates stay low forever. As soon as interest rates don't stay low, we're going to get big corrections in the equity market. What worries me more is the next slide. We're going to get the credit markets blowing out. So this just shows the riskiest corporate debt in the United States is now trading at its lowest level in a decade or two. So you get spreads blowing out, you get financial market dislocation, and this is just not my view. It seems to be the Federal Reserve's view, in that it's issued a financial stability report that is speaking about too much froth in the markets, too much leverage in the hedge funds, etc., that can give financial market problems. I would just say that what we saw at the start of COVID is we saw the dollar being strong when there was a lot of financial market instability. I don't see why that's not going to occur again. So if we go to the next slide, I'll just talk briefly about the emerging market economies. The next slide shows that the external position isn't a problem. John, if you could go to the next, that's, they're running current account surpluses, so that's not the problem. And if we go to the next slide, the problem's not that their currencies are overvalued by any measure. It looks like their currencies are reasonably priced, that it's fairly competitive. But it's the following slide that is the cause of problem. We've got debt levels for emerging markets that are, through the roof. That Brazil, for instance, debt to GDP for an emerging market country being 100% is really the danger sign. But you've got that for India, you've got it for South Africa, Hungary, Colombia. All of those countries have got very high public debt levels. But what they've also got, if you go to the next slide, is they've got very large fiscal balances. So what we're going to see is those debt levels go to very much higher levels. And once again, the only thing that is holding this up is that interest rates in the United States are zero. The Fed is expanding its balance sheet by $120 billion every month. So you're getting people stretching for yield, but the party will come to an end. When the party comes to an end, that is dollar supportive. So just the last point that I'm going to make is just to take a look at Italy. If we could go to the next slide, please. Go one further. This chart just, I think, tells it all about Italy. We're not talking about their rickety banking system or their politics or other stuff, their sclerotic growth. We just look at the debt. The country's 150-year history, we haven't seen debt levels of this sort. But you go to the next chart, and you see the budget deficit in Italy is around about 11% of GDP. Now, the trouble with Italy is it's stuck in a currency union, so it can't depreciate its exchange rate. So I'm not quite sure how you reduce the budget deficit without tanking the economy. But if you tank the economy, then you complicate their debt problem. So it looks to me that the euro's in deep trouble again. If we just go to the next two slides, this slide, just shows Italy. It hasn't been able to grow for the last 20 years since it's joined the euro. What we've got is we've got per capita income in Italy in 2020 is below where it was 20 years ago, whereas Germany is increasing by 25%. And just the final slide that I've put up just shows one of the major problems is Italy is not competitive. So I don't see how this all works out. They can't depreciate the currency. They can't really tighten their belt. So there are only two possibilities, at least in my mind. Either the European Central Bank buys Italian bonds forever and ever, even though this is the third largest country, it's got a massive bond market. The European Central Bank is going to have to keep buying Italian bonds. That should be a weakening factor for the euro, or we're going to get real euro crisis again, which also isn't good for the euro. So those are my three reasons. One is I think we're going to get financial market bubbles bursting, dollar supportive, emerging markets in real trouble because their public finances are shot. They don't have COVID under control. I don't see how that's going to get better soon. And the final thing is Italy is going to just weigh down the euro. So everything depends on, I take issue with Steve Roach is, I think even the Fed is going to have to move on the interest rates in some time. And if they don't move on the interest rates, you're going to get a backup in 10-year bond yields that's going to be even worse than if they actually tapered. So I don't see how you get out of the bubbles bursting. So on that optimistic note, I'll end.
Thank you, Desmond. I have to run and call my broker and sell everything, so we may have to end early.
But what would you put it into, Stephen? That's the question.
I don't have a clue. I mean,
it's got to go somewhere, right?
This is a very bad time for savers that want to put their money into safe investments and then put it away, to have a larger nest egg to support themselves in a comfortable way in the future. There's no good alternatives. So if anybody here had any great investments that would solve that risk return problem, our audience would be greatly benefited.
But I don't see why you say that, Catherine, because you can always go to the short end of the treasury curve. That you can.
Oh, well, okay. So you can preserve capital. You can preserve capital,
right.
but
that's the name of the game.
Right,
That you're going to have a financial crisis. You're wanting to preserve capital. You're not wanting to.
But then, of course, that just ends up with a steeper. That means that the Fed can't. What do they do? They can't raise rates, right? Because you've got everybody coming in. Steepens the yield curve, and that creates its own turbulence.
Now, when the bubbles burst, we're going to have another round of the Fed expanding its balance sheet by another $4 trillion. So we kind of just keep this show going.
Right. But so actually, apropos of that, Desmond, so I was a little bit, I can totally see why an emerging market crisis or an Italy or Euro crisis boost the dollar. You seem to also be making the argument that a U.S. financial crisis lowers the dollar, and I don't quite understand that. So maybe you can flesh out that.
I guess I'm just influenced by what happened in 2008, 2009. You had a Lehman crisis that was centered on the United States. It caused a global financial crisis, and all the money came into the United States. So I don't see why this isn't going to be something similar. But what I'd say is that this time around, it seems to me that the United States banks are in a very much better shape than, say, for instance, the European banks. So that would be another reason why people are going to be fleeing out of Europe, coming back into the United States. And certainly the money will come out of the emerging markets. That the money is already coming out of the emerging markets. We're already seeing the Brazilian real and the Turkish lira and the South African rand. All of those countries are getting their currencies are getting beat up already, and we haven't even started with the raising of the interest rates.
Stephen?
Yeah, Desmond, I just want you to reiterate the bubbles will burst because of the backup at the long end of the yield curve, which is driven by inflation. Is that what you're saying?
Yeah, well, that if you do get the long-term rates rising, either because the Federal Reserve increases interest rates, or in the case the Federal Reserve doesn't increase interest rates, they rise further, then the discount rate for all of these other assets.
Yeah, no, I get that, but I'm just trying to get at what is driving, in your view, either the Fed or the long end. Are you just focusing on inflation?
Yeah, absolutely. What I'm saying is that what we're doing is we're throwing 12% of GDP at a 3% problem, and we've got a whole lot of pent-up demand in the economy. I don't see how we don't get really strong inflationary pressures. So if you get the strong inflationary pressures, that's going to be driving up the interest rates. When the market figures that out, you're going to be getting the long. And we're already seeing this already started. I mean, we've gone from something like 0.6 on 10-year treasuries to something like 1.6 over the last 9 months. So that process has already started. As soon as you see more inflation prints, I would imagine that process accelerates.
Well, the Fed wants inflation, though, right? So, I mean, how bad is the inflation going to be?
The Fed wants inflation. They shouldn't wish for what they want. They're going to get it in spades. They're going to have so much inflation.
Well, we can talk about inflation, but there's the other story, of course, that with the 13% of GDP, and I'm not sure about that number, but it's a big number. It's a big number. You end up with, real interest rates rising, especially at the long end. And then what you have is all of those long-term, all those foreign official entities as well as long-term capital investors who flood into the United States to buy 10-year treasuries. And so you dampen the steepening of the yield curve with all those foreigners coming in. We've already seen it happening this year. We saw it back as a very strong feature of the post-GFC period. So, there's an awful lot of, this is where the dollar is safe haven, both as a shock safe haven, but also as a higher real interest rates on safe U.S. government securities at the longer end is very attractive to your foreign investors, official and private.
So the beauty of Desmond's argument is that if monstrous fiscal stimulus does not cause a crisis, then interest rates go up a lot, the capital floods in, and the dollar rises.
Yeah.
Or if monster fiscal stimulus causes a crisis, then there's flight to safety flows, the capital rushes in, and the dollar rises.
Win-win.
Yeah, so it doesn't leave a lot of opportunity. But actually, following up on that, Catherine, so as I mused before, I'm just a little surprised that the 10-year Treasury yield's been kind of stable around 1.6 for quite a while now. Mm-hmm. Notwithstanding what at least some people characterized as a surprisingly high April CPI print, is part of this. I mean, is the market just discounting all this data, or is it maybe the capital flows are already coming in, or
right? So both foreign official and foreign private purchases of U.S. Treasuries have been very strong over the last 6 months. So you do have that as a driver. And let's face it, the market is just not sure yet whether or not this April number is temporary or is going to be persistent. And we've focused a lot on the different arguments, the different components of inflation, that you need to look at all of them. You know, is it well anchored? What's happening to commodity prices? What's happening to wages and labor markets? And then ultimately what really matters is, do firms have pricing power? And looking at all those three elements, or four elements, you know, there's a lot of cross currents in where inflation could go over the next couple of months. So markets, you know, there's some who sort of say, yeah, we're going to be at 6% inflation pretty soon, and the Fed's behind the curve. And then there are other people who sort of say, well, you know, this is a base effect. It's you know, energy's going to come off in 2022 because of increasing supply relative to demand. Workers haven't been, you know, there's not transformation of the wage Phillips curve in the last 6 months. And then the real question, as I say, becomes, I think, that what's happening to firm pricing power, because in the end, you don't get spiraling inflation, cost push or demand pull, unless you get firms having pricing power.
All right.
I'm with Desmond. I just don't see how 12% plus stimulus plus pent-up savings in a 3% output gap does not lead to a lot more inflation than the 2.5% that the market expects.
Although, Joe, you're based on your recent article, you're okay with the notion it'll be transitory, right?
Well,
Are you changing your tune?
transitory, but more than I think the market expects transitory is just this year. I think transitory is the next three or 4 years.
The market won't call that transitory.
That's not transitory.
Well, exactly. So I think the Fed and the market is going to wake up a year from now or next March and realize, oh, it wasn't just a 1 year blip. It's actually persisting because unemployment rate is down around 3%.
Wow. Well, I'll tell you what, I think we're beyond our 3:30 end, although that's not a hard stop. But some of you might have real work to do, not me. But maybe we could, all you panelists could just would like to say a few last words, whatever you'd like the audience to take away. Maybe starting in the order you talked before, Catherine.
So I think that my argument is that you really need to look at decompositions. You got to look at the time horizon of what you're betting on, and based on and then looking at our underlying theory, it still plays a role. And those factors are going to lead us to very different views on what the dollar is going to do against whom over what time horizon and which drivers are most important. So that's not an answer. It just sort of says there's a really big buffet table out there. You know, try a little bit of everything.
Stephen?
Well, I think you've heard a lot of arguments today as to why the dollar cannot fall under virtually any type of scenario, and I'm suspicious of everybody loading up on one side of the boat. The dollar's fallen 3 times very sharply since the end of Bretton Woods. It can happen again, and that's where I'm betting we're going to see a significant shift at some point in the next, whatever.
All right.
So I guess I would say that although I've been worried about dollar policy and the U.S. trade deficit for years now, this year is really a very different and unusual year. The U.S. fiscal situation and the vaccine success in the U.S. is conspiring to, I think, cause a huge boom. And I'm with Desmond. I think ultimately, when markets really catch on, I think in the near term, meaning the next 2-3 years, we're going to see more dollar strength. Over the longer term, I'm with Stephen. Maybe it'll get weak again. But this means that it's probably not the ideal time for my views of dealing with the long-term overvaluation of the dollar, because we need some overvaluation of the dollar, at least in the near term.
Desmond.
Yeah, I guess my view is that you should really look at the fundamentals. That's going to drive the situation. The fundamentals are totally out of whack. And I just mentioned that markets very often have missed the fundamentals by a big amount. That when I just recall about the European sovereign debt crisis, the eve of the European sovereign debt crisis, Greek bonds were trading at 18 basis points over German bonds. To the market, it came as news to the market. that there was going to be a European sovereign debt crisis. I think that one day they'll wake up and they'll just see these forces, and then we'll get the dislocation that I'm anticipating.
All right. Well, thank you all for these really useful and interesting presentations and discussions. I think we've actually had a nice opportunity to really hash out some important issues. And so much appreciated. I've certainly learned a lot, and I hope, and I thank our audience for tuning in as well. So I look forward to seeing you all in some less virtual context sometime soon. Thank you.
Thanks very much.
Thank you.
Yep. Bye-bye.